Alright, what's up guys? Luke here. Welcome back to the channel and part 2 of how to fix your credit. And basically now I'm gonna kind of explain how it applies to getting a car. Some of the scenarios that I went over, some of the scenarios that have happened to me in the car business, and how you might be able to manipulate your credit to get what you want as far as a vehicle goes. Um, and I have to wear this headset because I couldn't get my other mic to work. I don't think my camera can input USB and then source a regular 3.5 millimeter jack. So I guess I'm just gonna have to wear this headset around my neck. So, I'm not saying on my old video it seemed like, you had to get perfect credit, to go get a car. That's not true. To lease, you should probably follow what I told you. But if you're gonna buy a car, there's a lot of different things that you can do to get that a little earlier and not have to go through a buy here, pay here, Not saying that all buy here, pay here's are bad, but most of them don't report to the credit agency. They will when you repo the car or you give it back or you miss a payment. They'll report, but they don't report your good payments. So it's not the best idea to go there. Plus, you're going to be paying so much in interest that it's not even going to be worth it. So, just to give you an idea, I've actually got people financed in the 400s as far as credit score goes. It's not saying that that's impossible. There's just different things that need to come together that the banks look at. So, for example, that 400 credit score, four something, it was like a 460 or something. Why I got them financed is because they didn't have any repos. They just had a bunch of collection accounts that were, written off. Basically they would get credit, they'd pay a little bit, and then they wouldn't pay it. So basically what you need to do, it's going to be kind of annoying here. Okay, so if you really need a car and you know your credit's not that great, okay, so what you need to do is if your credit's not going to come through for you, you need to have the other two parts of the triangle, which is money down and income, provable income, because there's a big difference between the two. So these people had money down. It wasn't too much. I mean, I think it was like $2,000, which I know is a lot to a lot of people, and me too. But that helps a lot. The vehicle, and also the other big part is your provable income. So these people, made decent money. And when I say decent money, around 3,000 a month is like a good spot to be at. Now, there's a lot of different things that go into play here. Again, the vehicle that you're looking at. Now, a lot of people say, oh, well, I don't have good credit, so I'm going to go get a used vehicle. That's actually not always the case. How that works, and this is a huge misconception, is that buying a used vehicle is what you have to do when you have bad credit. Well, that's not true. Banks actually like to finance new vehicles because they have a better value to them. So also rebates can help. So rebates in the eyes of a bank usually act as like a down payment. So if you can find a vehicle that has a cheaper vehicle that is new and has a lot of rebates on it, then that kind of helps offset your debt to loan, basically, value or value to debt ratio within the bank's eyes. So it's like what you're actually paying for the vehicle versus what it's worth to them if you don't pay for it. So that margin is a lot farther on a used vehicle than it is on a new vehicle, of course, if you make up with that with money down. Well, see, on a new vehicle, the rebates help act as money down. Not saying that you won't still need money down, but if you have money down plus rebates, that makes it even better of a chance of you getting approved. Rebates don't help with your down payment or your actual monthly payments. They're just going to help you get approved. So that's another thing that people, I think, don't understand a lot. But rebates are there to help get approved. So if you go in for, let's just say you go in for, you're looking for a $20,000, let's just say $15,000 used vehicle. Well, by the time you stack on your interest and, depending on your money down, you're looking at, $400 a month, $350 to $400 a month. And now you have a used vehicle that might be out of warranty. And so what the banks look at there is they're like, okay, well, if his car breaks down, he's barely scraping by making these payments or whatever it is, what's he going to do? Well, he needs to get to work. So he's probably going to fix his car instead of pay us your car payment. So it's kind of one of the things that the banks look at and think about. Whereas if you had a new car, not only is it a new car, parts are more readily available, but it's under warranty. So you don't have to worry about those big claims. So if your air conditioning goes out, well, you're not putting out, $1,500 to the repair shop. You can put it towards your payment because they've got that covered. So don't, you know, push away the fact that you can't get a new car. So yes, your payment is going to be higher on a new car. Yes, but your chances of getting approved are much, much better on a new car than a used car, unless you have a great sum of money down. Then you can go look around for used cars. So that's just one thing to kind of keep in mind that a lot of people don't understand. When you have bad credit, it's actually a little easier. Now here I'm talking about real dealerships here, not buy here, pay here's. Okay, buy here, pay here's are a totally different ball game. They can do whatever they want with their own money. I'm talking about real dealerships where you want to get real credit and you want to build actual credit score. They like new cars better. So when you're going to look for that car, those are the three things that you need to have that they look at. It's going to be credit score, money down, and the vehicle that you're buying. So if you don't have one or two of those, you need to make up with it on one or two other things. So these people didn't have credit, but they had decent income and they had money down. So those are the two things that you're going to need to do. If you don't have either, you don't have any credit, you don't have any money, that's probably not going to happen. Yeah, middle finger, exactly. So that's when you have to go back to the first video and just start working on that credit. You can't do it without having all three of these. You have no money down, you have no credit, and you have no income. So it's like you're kind of stuck there for a while doing the things that I mentioned in the previous video, or going to a buy here, pay here until you can find one. So that kind of gives the gist of buying a car with either troubled credit or see, that's how that works out. So but if you have really good credit and you got okay income and you don't have any money down, you can probably get something because you've got the good credit. Or let's just say you have not that great of credit and not that great of money down, but you make good money. Well, you've got a little bit better chance just because you have that income, but it's got to be pretty extensive. And then your credit file has to be, okay, well, he's got some medical bills or he just got behind, but he did have a good credit history. He's just in a rough spot right now, and he's making good money, but the other thing about that is like if you're making good money, you should be able to come up with a little bit of a down payment before you go looking for a car, unless it's an absolute necessity. You just broke down and you need a car. That might be able to help you if your credit's not so bad. If you kind of get the idea here is you've got to have a little bit of a mix of all of them, or you've got to have two pretty good strong suits to overweigh that one other one that's not so great. If you're weak in all three areas, you just need to work on your stuff before you go in there. All this is going to affect your interest rate and your term. Typical terms are 60 months. Of course, now 72 months is probably more typical. And with decent credit, you can get up to 84 months if you really need to keep that payment low. Now, the higher the term, the higher the term usually is going to bump that interest rate up. So let's just say you have a 3% on a 60 month. If you want to go to 72, it usually brings it to like 3.5 or 4. And then if you want to get to an 84 month, it's usually like 4.5 or 5, all depending on your credit. So that's what happens when you extend the term. Now, 95% of car loans are simple notes. So if you want to, let's just say you got the car and then you got a promotion halfway through your loan and you wanted to pay it down or pay it off, that's fine. You're not going to get penalized for that. That's actually a good thing. And usually, depending on the bank, if you make it, don't just pay more on your normal payment day. If you pay in between, let's say your payment's due on the 15th of the month, and you want to put extra down on it, don't just put extra on the 15th. Do it on the 20th or the 25th or basically any other day than the day that your payment is actually due. And normally that'll go directly to your principal. So what the principal is, for those that you who don't know is it's not interest. So you don't pay the interest on that payment. So when you take a normal payment out, you're paying the interest to the bank and then the principal of your actual loan, like what you owe. So if you're paying, let's just say it's a $400 a month payment, well, at the beginning, 100 of that might go right to interest, and then 300 goes to your actual loan balance. That's why how banks normally work is when you look at it, what's called an amortization schedule. Um, it basically, the banks get all their interest up front because there's a better chance of them, you defaulting sooner than later. So they want to try to get all their money, which is the interest, up front. So it's scaled as almost, it's pretty bad. It's like 50-50 almost. It's like if you have a $400 payment, the first payment, like $200 is going to the interest and $200 is going to the payment. It's not that bad, but it's pretty darn close at some point. And that goes down slightly over time. You can ask your finance guy for the amortization schedule or your bank, and they'll give it to you, and it'll break down your $400 payment and show you how much of your $400 payment is going to the interest and how much of your $400 payment is going to the actual principal or balance of your car every month in sequence throughout the whole entire term of the loan. So that's kind of neat to look at. So if you don't make an extra payment, let's just say you do make the extra payment on a different day, it doesn't take out interest. It goes right to the principal. So that's what a lot of banks do. So if you're going to put extra money down, that's great. Do it outside of the normal payment, and that'll just make the balance go down quicker and take some of those payments off the very end of the cycle. Now, that's also why I'm bringing up another point here. Why it seems like everybody is so much or so far upside down when they go to trade their car in. So a lot of people seem to, let's say they keep their car, a year or two, maybe 3, and then they're upside down, which basically means they owe more on the car than what it's worth. So when you go to trade in a car, which is, I'm not saying it's a bad thing, everybody does it, but it's the way to get the least amount of value for the vehicle that you have, because you're basically selling it wholesale to the dealer so they can try to make a profit on it for convenience, because you're basically just giving them the keys. You're stepping away from it. You don't have to bother with, Craigslist or selling it or blah, 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 and waiting for them to show up and look at the car and nitpick it and then negotiate a price. And especially if you still owe on the car, then that's a whole other world. It gets complicated. So you're paying a premium or losing money on your car to not have to deal with any of that. So people are like, oh, I'm so far upside down, or they feel like they get screwed, from the dealer, because you go to check on the value of your car 6 months after you bought it and you're $8,000 in the hole. Well, a lot of people don't put money down on cars. Okay, so you might be thinking, oh, I don't put any money down on a car, I got good credit or whatever. Or they always try to do it with no money down. What they don't consider is, okay, so they bought the car at retail. Okay, so yeah, immediately you can probably say there's about $3,000 or $4,000 of negative equity in the car, because when a dealer trades something in, it's usually the trade-in price is usually about $3,000 to $4,000 less than what they were going to sell it for, because that's their profit, that's the margin in case they do sell it or don't sell it if it goes to auction, and then they have to sell it for wholesale price. All that kind of good stuff, the maintenance for keeping it on the lot, reconditioning fees, whatever. So that's a $4,000 hit right there. Well, then you don't add in the fact that you just paid taxes, right? And then now you've got interest that is, when you're making your payments, it's not actually paying the principal of the car, the loan, it's paying the interest. So yeah, if you check on your car 6 months down the road and you're like, oh, I've been making $500 a month in payments, I should have $3,000 taken off the car. Well, no, because half that payment you're paying every month is going towards interest, not the balance of the car. So that's why 6 months or a year down the road, you can be $8,000 upside down, because you've taken that $4,000 hit right off the top, and then your payments, you're making minimum payments, aren't going towards the principal, and then over time you're adding mileage. That's another big thing that people don't really consider. They just drive the crap out of it, and then they wonder why their car's not worth that much. So you're adding mileage, you're adding time to the vehicle, which goes down every month, and your interest is not, your payments are going towards interest, not the actual vehicle itself. So that's why it seems like people get so far upside down, because then no money down, and then they go to check the trade-in value a year or two later, and they're wondering why their car's not worth anything. Well, those are the reasons why. So, to get yourself in a better situation, either set yourself up to buy something slightly pre-owned, which is, if you don't absolutely have to have a brand new car, buying it a year old, is a good thing to do, like a certified pre-owned, because that takes away that initial hit of depreciation. And then you get yourself a car that's still in warranty and has an extended warranty usually when they're certified pre-owned. So that's a good way to do it. And of course, having good credit helps that interest rate to where you're not paying so much interest, and then having money down. So those are all three things you can do to kind of help negate some of that, my car is not worth what it should be. And also, another thing is, are you buying the car to trade it in? Then you've got to keep that in mind. Most people, if you bought it and you're going to pay it off, well, then you're good. Then you end up with, a large sum of money at the end of the car. It's worth something at the end of the loan, unless, of course, you bought a $10,000 Dart, and in 5 years, yeah, it's probably only gonna be worth like $3,000. So there's different ways to find a car that's going to be worth something at the end versus, I just needed to do this for me right now. I can handle the payment. We'll deal with it at the end, or we'll deal with it 3 years down the road when I can afford a better car. So there's a lot of things that go into the situation with credit and buying a car, and what it ends up being, and how much it ended up costing you. And you go to trade it in, there's a lot of different variables here, and I could probably go on for a long time. But I try to get a little bit of the bad credit stuff out of the way if you're going to actually try to buy a car. If I missed anything, or you have a question I might be able to ask, go ahead and put it in the comment below. I'm going to kind of move over to leasing a little bit. Leasing, yeah, you do have to have pretty good credit to do that. Yeah, you can't really have, repos or things in collections. You get judged by tier systems usually in leasing. So where you have a credit score matters here, but then you get put into different tiers, and then that's how they charge you the interest. But on a lease, it's called the money factor. And the money factor is different than an interest rate. It's usually something around 0.002 XXX, or the really good ones are 0.000 XXX. Now you take that number and times it by 2,400, and that gives you kind of a relative interest rate. So let's just say tier 1 people, that's your good credit, no issues, probably over 700-ish. They're going to get the best. They're going to get the best money factor or interest rate. Just like if you were buying a car, you would get the lowest interest rate or the best interest rate. So that then you have usually tier 1, 2, 3, 4. Sometimes they go all the way to 5. But that's going to judge what your actual money factor is, and then that's going to judge what your payment is on a lease. Same as it does when you buy a car, because how much your interest is going to make your payment go up. If your interest is higher, well, your payment's going to be higher, and you're going to be paying more interest to that bank and less on your principal. So on the lease, let's just say that it's your term is 0.00011. Okay, so let's just say that equates to 0.25% interest. It can get really low on leasing. Well, if you're a tier 2, that might go to 0.0067. Okay, so now you're more like 0.75% interest, or, well, I'm not doing the math here. I'm just saying it creeps up that way when you are in a lease. So just to know like what they're talking about if you get into that, or what you need to look at when you're going for a lease, is what tier did they put you in, and what is the money factor. And then versus, if you're a tier 2, they're saying, oh yeah, you're a tier 2, but you're like a 750, and you've got great credit, and you're like, well, why am I tier 2 and why am I not a tier 1? These are questions that you might want to ask. And what's the difference between tier 1 and tier 2? And do a little bit of research on what those tiers should be from those manufacturers. A good resource is forums. So if you're looking for a Dodge, You know, the Hellcat forums or Hellcat.org or, you know, Scat Pack forums or, you know, just Charger forums. There's a whole bunch of different forums out there, and there's a lot of inside information out there. Since I'm no longer in the car business, I won't have direct access to that. Now I go basically to there if I need some. So that's a good resource for that. And then down payment really in a lease. I know I've gone over this sometimes in my other videos, but all the down payment really in a lease is going to do is lower your monthly payment. So it doesn't help you get approved like it does on buying a car. The bank is solely going on, okay, this is what the car is worth now. This is what the car is going to be worth in 3 years. This is his credit. This is how much money factor or interest we're going to charge. And can he afford that payment right now? And that's basically what they do. So if you want to, they figure that number out without money down. And then if you're like, okay, well, the payment's going to be $600, and you're like, well, I want it to be $500. Well, you're going to put that money down to make that payment lower. It's not going to help get you a better tier. Like money down doesn't help get you a better tier rating. Whereas in some cases when you're buying a car, sometimes that can help get a better interest rate because it's lowering the overall term or balance of what you are paying for. That doesn't matter in a lease. It's all kind of set in stone. The only thing the dealer can really play with is the money factor. So you have to keep that in mind too. They can basically add on to the money factor with their discretion up to a certain point. So if that was let's say that I went back to your tier 1, 0.00011, well, the dealership, even though you're tier 1 and you came back tier 1, they don't have to give you that 0.00011. They can bump it to 0.00044, and then they make that profit. So that's why you kind of want to know what those are and find out what the actual numbers are from a couple different sources. Some dealers will just tell you if you ask them, but they might tell you the wrong number. So that's why you want to maybe ask a few dealers or try to get some information online on what they actually are, and those change all the time. So you can't get some old information from like 3 months ago and then think it's the same thing. They change at least every month, sometimes weekly, and they might not change, but they'll be updated. So let's just say it was 0.00011 last month. Well, it can be the same thing this month, but you still have to make sure it's the correct one and it's updated. So that's just a little bit of generalization on leases. Also, if you put money down, keep in mind, if you put money down on a lease, if something happens to the car where it's lost, stolen, or totaled, you don't get that money back. Yes, it's covered because it's not your car. The bank's going to take care of it, but let's just say it's completely totaled and you put $3,000 down. Well, they're going to wipe the loan out, but now you're starting over and you don't get that $3,000 back. So that's why a lot of people do leases, but they don't put any money down because of that factor. Now, I did, if you've watched my other videos, I did put money down. And I'll be honest, because I actually didn't know that, but that still wouldn't have stopped me because I wanted my payment to be a certain amount. And I was okay because I had that capital to do it with, and it was already out of sight, out of mind. So I just put it towards the car. I wasn't going to be driving it that much, so I just took the risk, and that's fine. You can do that. A lot of people do it. A lot of people put money down. That's fine, but you just have to know that going in, so you're not kind of, hitting the back end when your car gets totaled or stolen. Anyway, I've rambled on for quite a bit now, and I hope some of that touches on what you can do with, good credit, bad credit, what you might want to look for if you have good credit or bad credit when you're going to purchase a vehicle. So again, if you have any questions, leave in the comments below. If you haven't seen all my other videos on car buying advice and my 2018 Charger Hellcat, go check them out now. Leave a like and subscribe, and I'll see you on the next video, guys. Thanks for watching.